Well, good afternoon and welcome to our clients and other listeners on this sunny Tuesday afternoon in Toronto. Thanks for taking the time to tune in to our weekly webinar where we're going to talk about what we see happening in the global economy, financial markets, and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategy. So sit back, relax, and perhaps grab a glass of wine. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined on the call by my partner and colleague, Paul Tepsich, the founder of HighRock. Our financial planner, Bianca Tomlinson, is also on the call. We're going to have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask questions. Well, speaking of our financial planner, and as this week is Financial Planning Week in Canada, the Globe and Mail has published a special feature dedicated to financial planning topics. One article specifically touches on the lack of regulation on financial planners. Right now, anyone in Canada can call themselves a financial planner. The Financial Planning Coalition is asking provincial governments to adopt a single unified set of standards for financial planners. Until then, Canadians should make sure to investigate the qualifications of their financial planner. CFP certification provides assurance that the planner is committed to internationally recognized professional standards of competence, ethics, and practice set and enforced in Canada by the FPSC. The CFP designation is the gold standard in financial planning. You can go to the FPSC website to find out if your planner is certified. Now at HighRock, we pride ourselves for having the highest levels of education within our individual roles. And the FPSC is proud to recognize our financial planner, Bianca Tomlinson, along with 463 of her financial planning colleagues in the Globe and Mail on Monday.
Let me talk to you about retirement. 401k is the most sound way to go. Let's talk asset allocation.
Sure. You seem knowledgeable, professional.
Would you trust me as your financial advisor?
I would.
I would indeed. Well, let's be clear here. I'm actually a DJ.
No way.
I have no financial experience at all.
That really is you.
If they're not a CFP pro, you just don't know. Find a certified financial planner professional who's thoroughly vetted at letsmakeaplan.org. CFP, work with the highest standard.
So if you're a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About HighRock tab. So let's start with what happened since we were all together last week. And let's, as we do every week, check in on last week's top trending Google searches in Canada. On Wednesday, the poem In Flanders Fields was the top search as Remembrance Day got underway. On Thursday, the Nintendo Direct online event revealed new games and trailers for the holiday season. On Friday, Paris was the top search with over 2 million searches. On both Saturday and Sunday, UFC fighter Ronda Rousey received over 1.5 million searches as she lost her title fight to Holly Holm. Yesterday, Charlie Sheen was back in the spotlight, and today, the Star Wars Battlefront game review just in time for the holiday season. Once again, nothing in the financial news was Googled or a top Google search. So let's move forward and give you our weekly recap. U.S. and Canadian bond markets are a little higher on the week, but there was some tax loss selling driving high yield and preferred share markets lower. Well, today I want to focus on the spread between Canada and U.S. 10-year bonds over the last couple of years. Back in 2013, U.S. and Canada 10-year spreads were negligible. As the U.S. and Canadian economies diverged, with the U.S. growth picking up and Canadian growth stagnating. As oil prices weakened, bond spreads widened. Canadian yields fell relative to U.S. yields, and the Canadian dollar fell as well. It is an important relationship that gives us some clues as to what to expect next. Clearly, expectations are for higher long-term rates in the U.S. at the moment. Well, the World Equity Index was lower by about 1% over the last week at this time, and down on the year as a whole. The U.S. was the worst performer, down 1.5%, also down on the year, and Germany was the best performer at plus 1.2% this week. Last week, the World Index moved down to our first support point before finding short-term buying support over the last couple of days. The downtrend line that initiated in May should provide near-term selling resistance as it did in early November. Increased volatility surrounding the increased terrorist threat and central bank interest rate decisions should keep the markets in a wide range for the time being. But until there is enough buying to break the downtrend line, we will remain cautious. Should support at our first level fail, we would expect tests of the next two buying support levels. Last week, we received a listener question asking for more specifics on what the World Equity Index was. MSCI's All-Country World Index, ACWI, is the industry's accepted gauge of global stock market activity. Composed of almost 2,500 constituents, it provides a seamless, modern, and fully integrated view across all sources of equity returns in 46 developed and emerging markets. Almost 55% of those companies are domiciled in North America, 52% in the U.S. Companies like Apple, Microsoft, and ExxonMobil are the top of the list, representing the greatest weighting. Financial companies have the highest sector weighting. We follow this because we think it best represents global equity markets and provides us with a benchmark to measure our performance. Well, the U.S. dollar continued to strengthen through the week, and most commodities continued to weaken. Copper led the way. Copper continued to forge new lows not seen since 2009. And now remember, copper is a leading indicator of the strength of the global economy. The Bloomberg Commodity Index is at its lowest level since 2011. Well, volatility moved higher late last week, but slipped back closer to its 200-day moving average over the last couple of days. The trend is pointing, though, to higher levels of volatility in the future. So what happened in the U.S. economy last week? Well, last Thursday, a plethora of governors of the U.S. Federal Reserve spoke about the need to get interest rates higher off of the 0% level. Remember that they want to see indication that inflation will be returning to the 2% level. They may have it now with wage inflation starting to appear. At the same time, High Rock was on BNN suggesting that there will not be a Santa Claus rally this year in stock markets because the Fed would likely raise interest rates in December. Oil prices and the Canadian dollar are headed to test lower levels, and that there were advanced signs in the U.S. economy that the U.S. economy might be running out of steam because, as we mentioned last week, there is a historic correlation between recessions and the rising inventory to sales ratio. This may be an early warning of a slowing U.S. economy. On Friday, U.S. retail sales continue to show a slowing trend, while inventories continue to rise, a worrisome sign. October industrial production reported today slipped. However, the manufacturing component did surprise to the upside. And consumer prices and core consumer prices edged higher. The core personal consumption expenditure price index, which is what the Fed focuses on, will be announced later this month, so we'll be watching for that. Well, around the global economy, the Institute for Economics and Peace said Tuesday that the number of people killed in terrorist attacks around the world rose 80% last year. Terrorism is gaining momentum at an unprecedented pace, said Steve Killelea, executive chairman of the Institute of Economics and Peace. Now, according to the study, Western states were much less at risk of terrorist attacks from Islamic fundamentalism, and instead more prone to lone wolf attacks driven by political extremism, nationalism, or racial and religious supremacy. However, the attacks in Paris claimed by the militant Islamic State group could prove to be a milestone, said Killalay. The Paris incident, in many ways, is a watershed within Europe. It shows that ISIL has the capabilities to be able to launch sophisticated and deadly attacks in Europe. He said, warning that more private citizens are being targeted by the militant group. It's difficult to take the time frame forward 2 years to see the threat disappearing. The economic cost of terrorism, estimated by the study, amounted to $52.9 billion, a tenfold increase since 2000 and the highest level ever reported. Well, is this something that central bankers are monitoring? That remains to be seen. Now remember, uncertainty tends to make businesses and consumers put off making economic decisions. It is clearly too early to tell if this will be a factor, but increased terrorist concerns could bring more uncertainty to a global economy that is already struggling. Well, in the euro area last week, Eurozone economy advanced 0.3% on a quarter in the 3 months to September, slowing from a 0.4% rise in the previous period and below market forecasts. It is the weakest expansion in a year as GDP growth slowed in most countries, including Germany and Italy, while France expanded at a slightly faster pace. In Japan, the Japanese economy shrank 0.2% on the quarter in 3 months to September of 2015, the same as a downwardly revised 0.2% drop in the previous period and worse than the market expectations of a 0.1% contraction. It was the second straight quarter of contraction as growth in private consumption was not enough to offset a fall in capital expenditures and inventory. Those are the preliminary estimates showing this data. So what do we see coming? Well, from the bond markets, German and Japanese yield curves flattened after poorer than expected third quarter GDP data. German yields are now negative beyond 6 years as markets price in more European central bank monetary stimulus. A December Fed rate hike is 65% built into the short end of the U.S. curve. The Canadian and UK curves remain little changed over the course of the week. Well, high-yield bonds historically lead equity markets. High yield turned lower in 2015, in early 2015. The S&P 500 followed in August. And the recent move in the S&P 500 has not been led or verified by a move in high yield. History will tell us that U.S. equity markets are ahead of themselves. We think that they are going to have to correct lower to lessen the current level of divergence. Last week we saw this correct a bit as equity markets shifted lower, and while high yield also moved lower, it was somewhat less volatile. Now another listener question, why does high yield lead equities? Paul, I'm going to turn this over to you, but other than the fact that bond traders are smarter, as our high yield expert, would you like to offer up an opinion on this particular relationship?
Well, that clearly is the number one reason, because bond traders are smarter than stock traders, Scott. But more importantly, and that to be honest is part of it. It's probably a twofold answer. Number one, all bond markets, and certainly the high yield market especially, is an institutionally traded market versus stocks, which are a retail traded market. So high yield bonds are over the counter, so they're not listed on a stock exchange like stocks. And they don't have a lot of transparency in the price, whereas you and I and everybody in the world can see where stocks are trading any day on your smartphone. The other part of the answer, I guess, is that high yield does require more fundamental research than stock research. Not only do we need to look at the fundamentals of a company, we also need to look at doing credit research, which requires digging in deeper to very complicated legal documents that are contained in the credit facilities and in the bonds themselves. So it does require more research, and quite often you find high yield research and high yield portfolio managers and traders, as we are, are a little bit ahead of the curve versus stock research, because we're looking at credit facilities that that might actually be a harbinger of bad things to come or good things. And one thing of note, just looking at the chart, Scott, is that it really has been an extremely volatile period since August for both credit and for stocks, for high yield and for stocks. But one thing to note is high yield, it's really been over October that the stock market has gone up so strongly and ballistically that it's left high yield in the dust. But I can tell you a couple things. High yield is about 6% lower than its peak in 2014 right now, while stocks are, almost at their all-time highs. Number one. And number two, I can just tell you anecdotally, the high yield market does not feel robust. It does not feel strong. It feels very, very nervous to me when I'm in and out, trading in and out of the market over the course of a day or a week. It does not feel like it's going to its all-time highs like stocks are. Okay?
Yeah, that's tremendous. Thank you very much for that insight. Well, we remain, as we have for some time, convinced that equity markets are expensive, and certainly that was a helpful rationale that Paul just gave us. Last week, reality returned briefly to equity markets as the 12-month forward average price to earnings ratio slipped back to 16.1 from the previous week 16.6, although the 10-year average remains very low at 14.1, very low relative to where we are now. The blended earnings decline for the third quarter is now at minus 1.8%, while the blended revenue decline for the third quarter is minus 4%. Now, at this point in time, more than 90% of the companies in the S&P 500 have reported actual results for the third quarter. Thus, it now appears highly likely that the index will report year-over-year declines in both earnings and revenues for the third quarter. Now, for the fourth quarter of 2015, the estimated earnings decline is minus 3.6%, while the estimated revenue decline will be or is minus 3.1%. Now, if the index reports a year-over-year decline in earnings for the fourth quarter, it will mark the first time the index has seen 3 consecutive quarters of year-over-year declines in earnings since the first quarter of 2009 through the third quarter of 2009. If the index reports a year-over-year decline in revenues for the fourth quarter, it will mark the first time the index has seen 4 consecutive quarters of year-over-year declines in revenues since the fourth quarter of 2008 through the third quarter of 2009. Now, for the whole year of 2015, the estimated earnings decline is now minus 0.3%, while the estimated revenue decline is minus 3.4%. So, again, we think without increases in revenue and without increases in earnings, stock prices don't belong at the current levels. And that very succinctly states one of the reasons that we think equity prices are expensive. In the other metric we like to look at, enterprise value to earnings, S&P 500 companies are valued at current market prices at 12.5 times. Now, the 10-year average is somewhere just a little under 11 times. And as we mention each week on these calls, our tactical growth model, we're not even interested in anything over 8.5 times. So, again, we look for value when we're making stock purchases. We don't think that there's any reason to be making purchases at current levels. Well, traders and investors who borrow on margin are reducing their borrowing against owning equities. This was indicative of a significant equity market selling back in 2007 and certainly raises red flags for us at High Rock. Just one more reason from the many that we have identified for us to keep greater weighting of cash in our equity models and portfolios. Cash is a defensive asset. And as we explained in detail last week, we think it prudent to have a more defensive strategy waiting for better value to purchase assets that we believe are currently overpriced. So what does it all mean? Well, we are in a low return environment, and I know I say that every week, but that's the part of the cycle where global debt levels are high, the global economy has been slowing, central banks are moving in different directions, and volatility is increasing as the uncertainty becomes more prevalent. Overvalued assets will experience a correction to more reasonable price points. And as we mentioned last week, our discipline is to protect our and our clients' capital in times like this. Now, we're not alone in this thinking. We get credibility from other well-respected economists who agree with our view. Cash and cash equivalents are important defensive assets. We cannot stress this enough. So we are carrying greater than normal cash balances in our models. I did go through this last week, but I'm going to do it again because I think it's really important at this particular point in time. Now, this is a short-term strategic allocation shift that we're going to use to protect our and our clients' capital. It also gives us the ability to put that money to longer-term work when asset prices get cheaper, as we believe they will. When new cash is added to a portfolio, we may determine that it is not an appropriate time to put that money to work because an asset might be overvalued. So we are prepared to wait for that asset to get to a more appropriate price point that represents better value. Now, there may be a waiting period for this to happen, so we may put the money to work in a short-term money market vehicle. However, the benefit is that our and your money not get repriced lower while we wait and find that purchase point at a better price. That's an opportunity gain and value added. So if you see extra cash or cash equivalent in your portfolio, it is because we believe that in the short term, there is an opportunity to take advantage of. Long term, depending on your tailored strategy, you can expect that we will use the short-term strategy built on your average annual return, which is an assumption in your wealth forecast. If we can improve our average annual return with short-term strategic tactics, we will be outperforming our targets. That is why you pay us a fee, to get the added value that our expertise brings to the table. What is really most important, of course, is reaching your long-term goals. That is why everybody needs a wealth forecast in order to set up a properly constructed strategy. And that goes back to the whole idea of financial planning. There are new taxes proposed that Canadians voted for in their need for change. Without a wealth forecast, you can't be certain as to how you will be affected, how your goals may be affected, and how your portfolio strategy will need to be adjusted. So we're in the process of contacting all of our clients to make certain that you are all aware of how you will be impacted. If you don't have a wealth forecast, it is time to come in from the land of uncertainty. So what's up next week? Well, we're heading into the U.S. Thanksgiving holiday on November 26th, and it is usually a time when markets tend to see lighter trading activity. But in between now and then, we have tomorrow, U.S. housing starts. We have the minutes from the most recent FOMC meeting, and we're going to see the Bank of Japan's interest rate decision. On Thursday, we see UK retail sales. Friday, some Canadian data, retail sales and consumer prices, as well as Euro area consumer confidence. And then next week, nothing of significance on Monday, but on Tuesday, prior to the U.S. Thanksgiving holiday, we'll see any revision to the third quarter U.S. GDP, which is a pretty old number by now. We'll also see an important information on inflation in the U.S., U.S. PCE price index and core price index, as well as U.S. consumer confidence. Okay, that's it for today's discussion. If anyone might have a question, please feel free to join us and ask it now.
One of the questions I have is if you could go back to that, well, you don't have to go back to it, but the slide with the PE ratios of 16 and 14, the average was 14 10 years ago. This, I guess my question is, like, I can see that you're waiting for prices to drop, like for the value to be lower, but in this day and age of so many people buying and selling their own stocks, like the discount brokers, you know, there's a lot of people that don't know what they're doing, that just they're thinking, I have to be in the stock market, is that not driving the price up? And can you then expect that it'll ever be, like the PE ratio or average will ever be that low again? Do you know what I'm saying?
Yep. And Paul, I'll let you address this in a second, but I'm going to just sort of quickly jump in, because one of the things, and we showed this a couple of weeks back, or maybe even a few weeks back, but most of the buying activity in equity markets over the last 4 or 5 years has been corporations buying back their own stock. And that in and of itself has been driving the price higher. Now, as far as retail equity purchases, on a net basis, they were slightly higher, but the bulk of the net buying of equities has been corporations, and that's been really the driver of higher prices. Interestingly enough, as earnings decline and there's less securities in the marketplace, it overstates that earnings per share number, and so that those numbers are actually going to be higher than they really should be, and that in and of itself is exaggerating some of the actual overpricing of equities in the market. So the value, and that's why we have that second metric, and Paul, you can jump in now if you want and just sort of maybe mention why we use that second metric, because it does give us a better representation of value.
Okay, so just a couple other things before I talk about enterprise value to EBITDA or cash flow is, I think the answer to our listener's question might be more along the line of, Scott, we did show, I think a couple weeks ago, the stock share buybacks by corporations, which you just talked about. That's a big driving force. It's been that way for about 4 or 5 years. But a couple other things that are adding to A, volatility, and B, certainly, as the listener asked, the ramp up in stocks that we've seen certainly through October is high frequency trading is a factor. Algorithmic trading has become very big and a factor, and then we've got retail. And as the listener asked, retail, who would think of going and buying bonds? They would only buy stocks because that's what they can get their hands on, and you can do it on your cell phone very quickly and easily. Back to valuation, companies don't buy other companies. You don't see mergers and acquisitions going through in the marketplace at a very high level. Big firms, even small firms, all the firms that we follow, from small cap to large capitalized firms, you don't see them buying each other on a PE basis or a price to earnings basis. You see them buying or valuing companies on an enterprise value to EBITDA or cash flow basis. That's how companies get bought and sold on a wholesale basis. So that is the true metric of valuation. And as you can see on that enterprise value to EBITDA chart that we have up, it's trading at around 12.25 times. That's higher than it was in 2008. Now, a lot of that is skewed, and so is the PE skewed by 8 large companies that are in the S&P 500 and the Dow. Companies like Apple and Exxon, mostly Apple and Netflix, and these fast-growing companies, because they're growing so fast, they deserve a higher valuation. But interestingly, Apple itself trades at a very cheap multiple. In fact, it's a stock that we would potentially look at buying on a bit of a sell-off, because it's trading at, I think, a 6.5 times EV to EBITDA multiple, and the S&P 500 itself is trading at 12.5 times. So what that tells us, as an example, is that Apple, maybe the market is saying, is seeing the best of its growth. Maybe it doesn't have a lot of growth left in it, and it's up to us as investors to make that determination. Does that help answer the question?
Yeah.
Sorry, it might have been confusing, but
It was a bit because I have nothing to look at on the screen.
yes,
You know what I mean?
You might want to go back to some of the charts that we were looking at, like the PE chart versus the enterprise value chart. That might be helpful. There.
Yeah.
There, that's the PE chart.
That's what I was talking about, yes.
That's 16.1, and you can see where it was historically. And then go forward one more chart, Scott. And that's the enterprise value, which is the total worth of a company versus the cash flow, or what we call earnings before interest and taxes and depreciation. And you can see where that is versus where it was in 2008, 2009. It peaked out at 11. We're up at 12 and a quarter right now, or bordering on 12 and a half. So again, this is the chart you're looking at now is a more pure metric to value businesses. And that's one that we follow in every company we look at.
All right. Thank you. One other question. I was kind of shocked that given all of the stuff that was happening in Paris, you know, Friday and over the weekend, that the stock market was up. What are the reasons for that? Like the Dow was up, the S&P was up. Today it's not so much, but I just thought everybody would be like, you know, in a big panic.
I think Scott, you can answer as well, I'm sure, but I think we sit here, Scott and I were talking yesterday numerous times and emailing back and forth going, this is insanity. But I think a lot of it is just kind of a few things, and you described one of it, like high-frequency traders and algorithm guys and retail, just like they got to rush in. I don't know, but
I thought they'd be selling.
Of course, everybody did, and maybe that's part of the reason why it went up. We're a little bit contrarian at High Rock as well, so we do try to look for how we feel like a specific market is overbought or oversold, and how the street or investors are positioned, whether they're, you know, everybody's long. Well, it's going to be hard for a stock market or a stock or a bond or any instrument to go higher if everybody's long and too long. And if everybody's too short, then, you know, it's highly likely that security is going up. So perhaps the market is not quite overbought yet. However, today was a good example. I think once a soccer stadium in Germany was a soccer game between Holland and Germany was canceled,
right,
and the stadium was evacuated rather quickly due to a bomb scare, the market started selling off. So it's insanely volatile. And to be honest, Scott, you can hop in now. We do not understand it 110%. We don't understand the rationale all the time, and that's part of our reasoning for being more in cash than we have been in the past.
Well, I also think that terrorism, from a big picture perspective, does potentially dampen economic activity, and dampening economic activity puts pressure on central banks to be more stimulative, ultimately. So that could be part of the thought process that people are going through or traders are going through. It's all very short-term.
Excuse me. So just before you go on, so for the central bank to be more stimulating, would it not mean that they might not raise interest rates?
Possibly. I mean, that may be. Now, it's going to be more impactful in Europe, where some of this stuff is happening, as opposed to in North America. And the thing about the U.S. Federal Reserve is they've been out pretty much talking up the fact that it's very likely they're going to do something in December. Now, obviously, things can change that, but I don't know that at this juncture that's going to happen at the U.S. Federal Reserve. However, in Europe, we're already thinking there's going to be more monetary stimulus coming from the European Central Bank. This may even exaggerate that or push that even further forward. So I think that may also be something that is out there, or the market is trying to grasp. And again, it's really difficult. And as I said, and as Paul said, I think we're going to see a lot more volatility. Markets will probably get thinner between now and once we get into the Thanksgiving, and then beyond that into that sort of Christmas holiday period. As we move towards year end, there's a lot of things going on as investors and portfolio managers and other traders look towards year end and making sure that all their ducks are in a line. So there's lots of things that go on. It may create even more volatility as we head into the year end. And it's one of the reasons that I was on TV saying I don't think there's going to be the typical Santa Claus rally this year, because it just doesn't seem to me like we're going to see strong buying.
Right. Thank you.
And just to add too, I mean, the fact that central banks, maybe even around the globe, save for the U.S., may add more quantitative easing or easier monetary policy, at some point that elastic band, as I think we talked last week, is stretched too far, and the valuation metrics are just not there. And at some point in time, people that are jumping into these equity markets near all-time highs at really stretched valuations, with the global economy slowing down, just because money is cheap and arguably going to get cheaper, that could be a very dangerous recipe to be borrowing money and investing in stocks at all-time highs at stretched valuations just because it's worked in the past, because central banks have eased. I don't know. Dangerous game.
Well, anyway, we are, I think, pretty much well over our allotted time. So I'm going to wrap it up. But again, we really appreciate getting questions, and we got some via email last week that helped us direct a little bit of our conversation today. So thank you for continuing to send questions. We want feedback. If you have the time, please send us questions, send us anything that you would like to hear about on our calls, because that helps us to give it direction. But that's it for another week. Thanks for taking the time. Sorry to be running a little over time here, but have a great rest of the week, a good weekend, and we'll be back with another report next Tuesday. And this is Scott Tomlinson signing off.